Hello everybody and welcome to this week's webinar, which is entitled Understanding the Numbers in Your Business. I'm joined by Edward Rofes. He's a seasoned financial executive who attended UCLA and California State University, where he obtained his accounting degree. He's a certified public accountant licensed in the states of Florida and California. His public accounting background includes several years at manager level with KPMG, and he has extensive experience, in fact, as a CFO in small and mid-sized organizations. In his position as CFO and member of the board of directors of Columbia Sussex Corporation, he was actively involved in taking the company from 1 billion to 2 billion operation over a 4-year period. He's here to share some of his wisdom with us, and I'm really excited to listen in. I think this will be slightly different to normal in terms of the fact that Edward is going to welcome a little more interactivity. So if you want to speak, I'll go through and unmute people who have any questions. Without any further ado, I'm sure that Ed will be able to explain it further. But thank you very much, everybody, and welcome to Ed.
Thank you, James. I'm coming to you from Florida, and I'm very glad to be here today. And I would also like to welcome you to Understanding the Numbers in Your Business. Our objective today is to give you some background that will enable you to not only understand the numbers that you see on financial statements, but also to be able to assess the quality, the reliability of those numbers based on a number of factors behind the numbers themselves. We will also talk a little bit about the analysis and ratios that a lender or investor would use to evaluate your numbers. I'd like to make this a two-way session as much as possible, provided it does not get out of hand. So I would like to encourage you to ask questions at the end of each slide when I will say, are there any questions? I would also like to ask you questions throughout the session so we can have a real two-way presentation. So we are going to unmute everything so we can do that. Are there any questions? Okay, let's get started. Can someone tell us what financial people mean when they say they are the financial statements are GAAP?
Actually, sorry, Ed, can I just pop in? Purely because everybody here is muted at the moment, their microphones are actually on. So for anybody who'd like to ask or answer a question, I think a lot of people here know the score now since they've been listening for quite a while. Just type into the questions box. You can literally just type unmute, and I can unmute you immediately so that you can have a discussion. Otherwise, we're going to have a lot of background noise from everybody who's in the session at the moment. Is that all right,
Ed? I'd prefer a little more activity. Maybe you can give it a shot and see if we can. If it gets too noisy, we'll have to do that.
Right, okay. I'll tell you what. I'll unmute people.
Maybe they can. There's microphones, and unless you're not.
Yeah, I think I'm a bit of a Luddite. I'm so used to having everybody mute.
How about when they say they are accrual or cash basis? All right. Well, let's discuss those three items. How reliable are the numbers? Are they GAAP? Are they audited, reviewed, or compiled? The accrual or cash basis?
Yeah.
What is GAAP? It stands for Generally Accepted Accounting Principles. I understand in the UK it's accounting.
All right, again.
It's also referred to as UK GAAP. All it is a set of rules commonly used accounting standards issued by, in America, the FASB, the Financial Accounting Standards Board. And that's the people that dictate what we do here in America on as far as accounting. So the origin is U.S., and these GAAP is being adopted worldwide, although in different versions. For example, in Australia, I understand it's the AASB. And in the UK is the ASB, and then there's also the IASB, the International Accounting Standards Board. It has a different set of rules. So what's important here to understand is that GAAP or any of the other uh,
Oh my lord, where are you?
okay. GAAP is the is just a set of rules so that we all can apply those rules, by all means accountants, the same way, so that we have a standard that we can compare numbers to. Any questions on this before we move on?
Nothing through so far.
Okay.
Somebody,
I'm wondering, perhaps you can unmute at the time that I say, are there any questions? How's that?
yeah, that was the only thing that I was looking at. But unfortunately, the Mac version, I'm using a Mac at the moment, and there's only a mute all button. There's not an unmute all button. So I can unmute people, but it will just be a case of doing it as fast as I can, if that's all right.
Okay. Okay. So the next question is, what is OCBOA? OCBOA. Anybody venture to guess what that is? Probably never heard of that unless you're an accountant. What it stands for is Other Comprehensive Basis of Accounting. It's another set of standards, but it's different from GAAP. It includes cash basis financial statements. It's much less complex than GAAP and is a lot easier to understand. Why does it exist? Because, again, it's less complex and easier to understand than GAAP, and sometimes clients just don't want to spend the money to have GAAP statements because it's not necessary in their particular set of circumstances. Any questions? Okay. Now, you've probably heard accrual financial statements, cash financial statements. Anyone want to tell us what the difference between those two concepts are? James, there's got to be somebody out there that wants to talk about this.
I'm hoping so. I'm just unmuting everybody now. We're about halfway through, and I'm just kind of scanning to ensure that the guilty party from earlier on doesn't come back into it.
Talk about cash and accrual basis. It's a methodology involving matching revenues and expenses. It's all about timing. And that is when an expense or revenue item is incurred as opposed to when money actually changes hand. Incurred versus paid. A good example of it is year end, for example. You pay your rent for January 2017. You paid it in December of 2016. Now, if you're a cash basis if you're on the cash basis of accounting, and you paid your rent in December or January, you would take the expense in December because that's when you actually wrote the check. However, if you're on an accrual basis, we have to account for that payment when it is incurred. Okay, so it would go into 2017 because it is for January rent. Any questions on that? Okay, these concepts are very important when you're interpreting how valid a financial statement is. If you're looking at a financial statement where, let's say you're the landlord in this case, the money came in January, declaring the income for that money in January, December, and you're declaring the income for that money in December, it could be misleading to think you guys have received that much more money in 2016 when it really is deferred revenue to the following year. Okay. Now, anyone know the difference between audited reviewed, or compiled financial statements? Are you sure nobody's talking out there, James?
Yeah, no,
Okay.
I'm sure. I think people are a little nervous. It's the first time they've done this before, so maybe people are just getting eased in a little bit.
All right, because we got time built in for the questions, and no question is a bad question.
No,
And
I really encourage everybody listening.
okay.
Just please do get involved. It's there's time for questions at the end, and it's a really good opportunity to pick Ed's brain. But yeah, I'll let Ed continue.
Okay. So, audited, reviewed, or compiled. These are the three levels of reporting by certified public accountants. This is based on U.S. Practice, and I'm pretty sure it's pretty familiar in other, similar in other places. So, when you get a financial statement from a CPA firm, it's going to be audited, reviewed, or compiled. Normally there aren't any other options. So the highest level of work that the accountant does is an audit. So in an audited financial statement, the CPA obtains a high level of assurance that there are no material issues and provides an opinion as to the fair presentation. The word material is key here. The concept of materiality is very important to accountants. A $2,000 expense in a $50,000 operation might be material. It's a good chunk. It's 4%. Whereas the same expense of $2,000 in a $20 million operation is not material and could be overlooked, unless, of course, there's a pattern that indicates a problem exists systematically. So, what we're saying is that he's obtaining a high level of assurance that there are no material issues and provides an opinion as to the fair presentation. The word opinion only appears under audit. You do not get an opinion on a review. You do not get an opinion on compile. And the opinion usually reads something like, in our opinion, the financial statements present fairly the position, da-da-da-da-da. Okay? So, have an idea when there's an audit, what percentage of your transactions are actually audited, looked at by an auditor and vouched for. Let's say, in general, let's say based on, so you're auditing the checks that were written. What percentage of those checks are actually looked at by an auditor? Anybody got an idea? Okay, it's they start out small. They start out assuming that everything works well, and what we do is we take a random sample that will generate a certain percentage of reliability. So let's say that your actual random sample generator programs, apps that you can use nowadays. And what you do is you put in, say, the first check number is 1,000, the last check number is 2,000. So you've got 1,000 checks in there, and that's not okay. So you have 1,000 checks between numbers 1,000, 1,001, 2, 3, etc., all the way to 2,000, and the last check being in 2,000. So that's called the universe. So they put in the universe, they put in the reliability level that they want, and that reliability level is based on a number of circumstances when they scope out the audit. They figure how important are the checks, for example, is one of the criteria, as opposed to a place where the inventory is what's really material, but not the payments. So they'll say, let's say normally they might start out with 3-5% of the checks. So they'll look at, 30 checks, 40, 50 checks. Well, by looking at those checks and auditing them, they're going to take a look, depending on the circumstances, of course, okay, was the purchase authorized by the proper person? Is there an invoice indicating what was purchased? Is there a receiving report or some indication that someone received the goods? or services? Did someone actually approve the actual payment of that invoice? Was a check issued? Did the check clear the bank? All of those things. So what I'm getting up to, it's a lot of work. So you don't do 100%. If you did 100%, you couldn't afford the audit. That's why the auditors do not guarantee you that they've looked at everything. They can't. You want to pay for that service. So now let's say that you do that those 50, 60 checks, and you come up with 5 checks that didn't come clean for some reason. What do you do next? Anybody?
Hi, Ed. Just a quick one. Someone asked in the written question box, I'm not sure if they maybe missed the very beginning of it, what is CPA? Just so that they can understand.
What is it?
Yeah, what's CPA?
CPA is a certified public accountant in America. I believe in Australia we also call them CPAs, but in England you call them chartered. In the United Kingdom, chartered accountants.
Yeah, exactly.
Okay. But same work, same standards, etc. Pretty much. Okay. So we were talking about what happens if you find 5 of those 50 checks aren't right. Okay. Well, at that point, you need to look a little further. So
sorry, somebody has answered the question as well, but in the text box, they said Larry has said that next you'd apply a percentage of accuracy to all. Is that correct?
Could you repeat that, please?
Larry says that the next step will be applying a percentage of accuracy to all. Is that?
Okay, yes and no. What you're going to do is if you started out by looking at, like we said, 3% of the checks, okay? 30 checks. And you find that you have 1 or 2 bad checks, you're not going to worry about it. It's depending on the error type, of course. If somebody actually signed a check that were not signers on the account, you got a big problem and you're going to dig a lot deeper. But if it's just a bookkeeping error or what have you, you may let that ride because it's not material to the situation. It's not big enough. But if you have 5, 6, 7, 8 checks out of the 30 that you pulled, you can pretty much assume, because you did a random sample, that you're going to have that much of a percentage that's not right all the way across. So what you do is you pull a bigger sample. You're back to your random number generator. You come up with more checks. Check number 1217, 1560, whatever. And then you look at those checks. And at that point, you take the whole sample together, first sample and the second sample, and you decide whether or not you're going to, you're satisfied that things are well or they're not. So it's all a matter of you start out small and you go deeper and deeper if you have to. If you don't, you say, okay, that's good, we move on. Okay? A reviewed financial statement is where the CPA obtains limited assurance. Yes? Limited assurance based on limited analytical procedures. Okay, what does that mean? The CPA does no auditing whatsoever under a review. All the CPA is doing is he's looking at the reasonableness of the statements. Is your gross profit in agreement with what you were doing in past years, in agreement with what other businesses in your industry are getting? Does it look like your cash balance is reasonable based on the size of the operation that you have and the working capital that you should have? That type of thing. So he's looking to make sure that based on some analytical procedures, he analyzes some things, reviews some things, and says, okay, yeah, they're okay. But there's no audit whatsoever done. Then the last level that we have is compiled. That's when the CPA obtains no assurance as no analytical work is performed. And the only thing the CPA does, he ascertains that they are GAAP. And we talked about GAAP before. That's the standards, generally accounting the procedures that are used to make sure that the statements don't have flawed assumptions as to how they were prepared. So the key thing here that you have to look at is that the CPA obtains, and I've made that red for a reason, because the CPA does not provide a high level of assurance. They're very careful in what they tell you. The CPA says, I am satisfied that there are no material issues. He doesn't say, hey, there are no material issues. I am satisfied with a high level of assurance that there are no material issues. But he does not provide any assurances whatsoever. Any questions? Okay. Can anyone tell us what the three fundamental statements are?
Apologies. Somebody did have a question. Larry wanted to know, is this all CYA for CPAs?
Yes.
Great. Perfect.
Absolutely.
Uh,
Yes.
and
They still get sued, as you
Candice,
know.
I think Candice answered your next question. Trial balance, profit and loss.
Very good. The profit and loss is one of the three. We have two others. The trial balance is an accounting document that leads to the financial statements. It's not an actual financial statement. Anybody else have the other two?
Balance sheet, says Solomon.
Balance sheet, perfect. And one more, and that's the one that's the rarest that we don't always see. Note that one.
Income statement.
We got that one. That's the same as the profit and loss.
Right. So Solomon, that was just a different vernacular for the same, or a synonym. I'm guessing Solomon must know the third. The capital statement.
Okay. Are we ready to go? We got another one.
Did you hear that capital statement?
Yes and no. It does address capital cash flows, but it's actually called a statement of cash flows.
Great.
So we have a balance sheet, as you pointed out. We have an income statement, as you pointed out, which is also known as a profit and loss, also known as a P&L for short, and also known as a statement of operations. All those are the same thing. And then you got a statement of cash flows. Okay? Now, the balance sheet is usually in front of everything else, and it's the one they talk mostly about. But I think I'm going to go to the income statement first because that one's a little bit more, shall we say, it makes more sense on a balance sheet to the average person. We all know what looking at your income and your expenses are and arriving at a profit and loss. So we're going to go ahead and talk about the logic behind the income statement. Okay, the income statement, profit and loss, P&L, is the results of operations over a given period of time. Year, month, week. The revenues minus the expenses of the enterprise are equal to profit. And that's pretty logical. So, any questions on the logic of the income statement? Okay. So now, when we're talking about revenues and expenses, let's talk about expenses for a minute. Anybody venture to tell us what the difference is between a direct expense and an indirect expense? Anything coming in?
Not yet. I think with typing, people may take a couple more seconds. Just as a quick, sorry aside, this is the first time we've done this, so I know it's a little more difficult. But for anybody who would like to speak through their mic, who has a mic working, they can do it, as everybody is now unmuted, aside from people whose mic wasn't working properly. So please do if you want to speak, but if you prefer to say something in the questions, that's fine. And in answer to your question, Ed, Candice says direct expenses cost direct to operations, indirect to more overheads like electric, I think, bills or utility bills.
That's pretty good. That's pretty good. Any other opinions on that?
Not so far, no.
Okay, all right. So direct is associated with a very specific product or service. Indirect is associated with the maintaining the entire enterprise, also known as overhead or burden. So overhead, burden, indirect is all the same. Direct is associated with a specific product or service. So if you're making tables, lumber is going to be a direct expense, whereas the rent on your building is going to be indirect. Now, there are there's another set of distinctions in expenses that appear to be the same, variable and fixed. So you say, well, variable, yeah, the wood's variable. The more you make, more tables you make, the more expenses you're going to have. Fixed, doesn't matter how many tables you make, you're going to pay the same amount of rent. So, but they're not quite the same. So I'll get into that in a second. Variable says vary with volume of output. Sounds like direct, but we'll go there in a minute. Fixed, independent of the volume of output. Okay, and then you got mixed. An example of a mixed expense is an electric bill when electricity is used in production and also throughout the factory. So you're going to burn a lot more electricity when you're running product because it's part of the process. So that could be considered a direct expense. And you're also going to be burning electricity all the time throughout the factory. So that's a mixed expense. Okay, what's the difference between variable and fixed and direct and indirect? Well, consider this. Let's say you have a supervisor that's salaried. That makes it fixed. He gets the same thing every month, no matter what production there is, as long as the production line is open. But his expenses are not indirect. They're directly associated with a specific product or service. So here you have a situation where you have a fixed expense that is also direct at the same time. So they're pretty close, these two sets of concepts, but they're not identical. Okay, any questions on that? Okay, the main reason for discussing direct, indirect, variable, and fixed is because you can read, or misread rather, your financial statements if you throw something in the wrong bucket. Okay, let's say that the lumber, well, that's not a good one because the table uses a lot of lumber. That's the biggest part. But let's say fasteners in that product that you're making, that table, are material enough to be an issue here. So let's say that your accountant, instead of putting that into direct costs, puts that into indirect costs. So here you're making this table and you think it's costing you 20 pounds, $20, and you're selling it for 23. So you're making a little bit of money. But the fasteners are $4, 4 pounds, okay? So, but you don't see that because your accountant put it in indirect. So every time you're making a table, you're losing 1. It's costing you 20 plus 4. You're only getting 23. You're losing 1. But you're not seeing that because it looks as part of your indirect costs on your financial statements. And it's getting bundled up with all the other products because you're making more than one product. So you don't see that this particular product is not priced properly or the costs are just, you need to do something about your costs and reduce them somehow, get different lumber or whatever. So it's really important that you determine if your costs are properly categorized as to whether they go into that product or they're associated with the entire enterprise. Okay? Questions? Okay. We're going to talk about the format of the income statement. It's pretty simple. You got sales, you got cost of goods sold, and you got your gross profit. Take that, subtract that, and here's your gross profit, also known as gross margin, which is a key number. If this number is not good, every time you make one of these, you're going to lose money. So it's important to have that number. You definitely want a positive gross profit, and the bigger the gross profit, the better. Then below that, you're going to list all your sales, general, and administrative expenses. Deduct that from your gross profit. So this is, in essence, your direct and variable costs. This is, in essence, your indirect and your fixed costs. And here's your net income or loss. Okay?
So just where is the operating profit here?
Where is the operating profit? Okay. Your operating profit is normally your net income or loss. Now, I've taken a shortcut here because what you would have is, in a real enterprise, below that, you would have non-operating income, non-operating expense. So we're talking about things like interest, okay? and they don't come above the operating income. So this is an oversimplification. I'm glad you pointed it out because we should talk about that. So you have, in essence, what you're looking at in my slide, what you're seeing is net income is really operating income. And below that, you would have interest, expense, and any extraordinary items, things like that, which would get you to net income. That answer the question?
Yeah, I think that was an excellent answer. Thanks.
Okay. So I'm going to show you a simplified little income statement here. Sorry, I don't know how to do a pound on the thing, so it's a dollar sign. You have to show me that sometime, James.
Yeah.
I think you have to hit 3 keys at the same time or something, and my dexterity isn't that great.
I think dollar's more ubiquitous anyway. I think everybody can get down with the dollar.
Yeah, every time I'm overseas, I have a hard time because I'm used to a QWERTY keyboard, and I go into one of those airline lounges, and they've got computers in their own language with the, and it takes me forever to type anything. Anyway, so you got your sales up there. You got your cost of goods sold. Now, slight variation. If you're a service business, you may call that revenue and not sales, or you could call it fee income. Okay, then you got your cost of goods sold, and again, if it's a service business, you would call it. I'm having troubles with my pointer. I apologize. There it is. Okay, so you would call this, instead of cost of goods sold, cost of services, or something along those lines. The main thing is that this is your direct costs that go into the product that's making you this money. So that brings it down to your gross profit. Then you go into your selling, general, and administrative expense. You've got marketing, wages, et cetera, all your overhead. Total of those, 18,000. And here we come down to net income or operating income. And if we had interest and other things, we would put those below here, and then you come down to real net income. Any questions on that? Okay, let's talk about the balance sheet. The logic behind the balance sheet is, as opposed to the income statement, which is the result of operations over a period of time, the balance sheet is the financial position of the enterprise on a very specific date. On December 31st, here's a snapshot of our assets and our liabilities. I think you all know what an asset is and what a liability is. Every business, every set of books has this formula that has got to work. Assets must equal liabilities. Now, some of you that may have been a little bit more about accounting might say, whoa, what happened to the owner's equity? Well, owner's equity is really a liability. It's a liability to the owners. So you got liabilities divided into liabilities to the outside world, liability to the owners. It's also known as equity. So the real formula that you see is assets equals liabilities to others plus equity. Okay? Any questions on that?
There was a question for the last slide.
Okay.
Excuse me, I didn't mean to cough. Candice asked a question. Candice was muted just before because I thought that there was some sound coming from her mic, but Candice, you're no longer muted. So if you prefer to ask...
Oh, hi.
Oh, great. Perfect. Well, go ahead. You can ask your question directly to Ed if you like.
Okay, so if you sell a service like us, we do drilling. Should the wages for the rig operators be in direct expense? So like cost of service?
Yes, particularly if they only work when they're drilling.
They don't. So a little bit more difficult to split up, but mostly, yes. They're
Okay.
mostly on site.
Is it possible for you to take those wages and have them allocated? Like when they're not on site, they're not working on the rig, perhaps they're in the office doing something else, and bring that portion of the wages down here?
Possibly. With a lot of changing of things, I guess.
Okay, well, the objective here is to find out if you're making money when you're drilling or not, right?
Yeah.
And if you're putting time that is not going into drilling in here, that's not giving you a true picture.
Yeah. Okay.
So,
Thank you.
If it's essential that you pay these guys for full time, or ladies for full time, and yet you don't have full-time work because, you know, there are a number of issues about, you know, transportation or what have you, then you have to consider, well, maybe if in order for me to be able to drill, I have got to pay these guys, period, then maybe you've got a situation like that supervisor that I used as example earlier, where he's a fixed cost, really, but it is a direct cost because if you didn't pay this guy, this lady, the entire amount of money they require on a paycheck every pay period, you would not be able to drill. Correct?
Mm. Okay.
Answer your question?
Yes, food for thought. Thank you.
Okay. All right. So we were talking about the balance sheet and the equation. Anybody got any questions on that? Okay. And we're going to now talk about how you divide assets on your balance sheet, how you divide liabilities. The key word for accountants is the word current. We define that as something that can be turned into cash within a year, or has to be paid within a year if it's a liability. So we have current assets that can be turned into cash within a year. Then we have other assets, and they're considered long-term or fixed assets. So normally, if current assets, of course, cash in the bank, securities, that kind of thing. And then you have accounts receivable, which you normally are going to get turned into cash within a year. So you have some real deadbeats. And you have inventory. That's going to be turned into cash by virtue of a sale within a year. Okay? Then you've got your fixed assets or other assets. Fixed assets, usually you're talking about plant, equipment, desks in the office. You're not going to turn those into cash. You need them to generate an income. And then you've got things like prepayments, like the utilities. You have to pay the electric company a deposit that you're never going to get back as long as you require electricity. I don't know about in your country, but in America, it's like that. Even if you have outstanding credit, they usually keep your deposit if you're a business for a long time. Well, I shouldn't say that. That varies. In Florida, people are really flaky, so they do that. In other states, maybe not. Okay, then we talk about current liabilities. Those are liabilities due within a year. You got to pay for them within a year. Okay, most of your bills are due within a year. But then you got other things which are considered not current or long term, and those are things like your bank notes, things of that nature. Now, why are these concepts important? Well, one of the key things that is you're looking at when you're looking at a financial statement is the liquidity of the business. Okay, how quickly can you turn things into cash? And that is a very important concept for lenders and investors, particularly for lenders. They want to make sure there's going to be cash there for data. Any questions on that?
Hello?
Yes?
No, I think that
Yeah.
Peter just answered the telephone.
Okay. Okay. So based on current assets, current liabilities, long-term or fixed, we're going to show you what a balance sheet typically looks like. You've got your assets, current assets, cash, receivables, inventory, that type of thing, property and equipment, such as
Hello?
the oil rigs in your business, and the other assets, you know, things that are prepaid that are going to be there for a long time. That equals total assets. Then you come down to liabilities. So you got your current liabilities, bills that you have to pay, payroll that you have to pay that's been earned already, and then you get your long-term liabilities. That's the notes and things that are due in a long time from now, beyond a year from now. Now, accountants actually go to the extent of taking a contract for him. But for example, you have a note for a car, even, and say, and they'll take the next 12 payments the next year. It's a monthly note, and they'll stick that into current liabilities. They will take the remainder and put it into long-term liabilities. So if you don't do that right, it could affect your liquidity. You could be showing more current liabilities, which will show you less liquid than if you didn't. Okay, then below that we have your equity, and now we have total liabilities and equity, which has to equal to assets. Okay, Here's a typical balance sheet, and I color-coded it to show the three types of things we have. We have the assets in green, we have the liabilities in blue, and we have the equity in purple. These are pretty straightforward. There's your current assets, you add your plant and equipment, liabilities, current liabilities, you add your long-term debt. Now, I want to talk a little bit about the equity section. Okay, the green and the blue are always, always, always identical. And regardless of whether you're a corporation, a partnership, a limited liability company, a sole proprietorship, you have assets, you have liabilities. However, the equity section varies greatly. Okay? If you're a partnership or a sole proprietorship, you do not have common stock. Now, I picked a corporation which has common stock in order to show you the different components a little bit better. Because if you have a sole proprietorship, you may just see down here, owner's capital. If you have a partnership, you could say partner A capital, partner B capital. Same thing with an LLC, member so-and-so capital. Okay, excuse me. Now, what really is common to all of these different types of entities is that the equity section is made up of these components. A, how much you invested. B, how much you've made. C, the reduction of that total by how much you've pulled out of the business, how much you've drawn out. And D, any losses you might have had. So what it comes down to is your investment plus or minus losses or gains minus whatever you've taken out. And that is what's left over in equity. Retained earnings is, in essence, what has been made less what has been paid out in dividends. And if it's negative, you've lost more than you've made. And that's a very clean number, which you do not see in partnerships or in other forms of ownership. But then, of course, you got your total liabilities and stockholders' equity down here, and that equals the 5,500 in assets. Any questions on that? Okay, we'll move on. Okay, we were talking about the least common of the three financial statements. Balance sheet, you've heard about. Income statement, profit and loss, you've heard about. Then there's a statement of cash flows. And here's the logic and the format of that. Statement of cash flows actually converts accrual basis, profit and loss, back to cash basis. So in other words, that rent payment that we made on December 31st that made our income not change, but it did change our bank balance at December 31st because we wrote a check. That's what we're talking about here. So that your net income, let's say, for the company was $100,000, and you wrote a rent check for $10,000 on December 31st. That rent check, if you're on the accrual basis, did not get reflected in that profit and loss because it goes into 2017 because it's not earned yet. It doesn't apply to that period yet. But when you go to the cash flow statement, it comes right back to cash basis and says, yep, you spent that money. And therefore, the cash went down, and therefore we're going to show it. Okay. Probably going to stop there and ask if there are any questions on that concept. That's really critical. Anybody?
Somebody's typing. I wonder if they're typing a question.
Well, hold on for a sec.
We shall just give it a second. It's Gary. Gary, you are actually unmuted. If you want to go ahead and say it, that's entirely up to you.
I think my question is
Yeah,
I'm sorry.
I don't know if you can hear me.
Oh yeah, I can hear you perfectly now.
Oh, yes.
Okay, my question regarding to writing the check is, it doesn't matter when the check is written or cashed or cashed/presented.
It's when you write it. Usually you record everything in the accounting world when it is actually the date of the transaction, the date on that check. You determines when that check when the transaction took place. The only thing is that you are going to, and this, without getting too complicated, what's going to happen is this. You write that check, and if you're on the cash basis, you write on December 31st, you're going to go expense rent. Remember, well, we didn't talk about this, but I'm sure every debit has to have a credit. So you're going to go to expense, rent expense with one part of it. The other part of it reduces cash. Okay? When you're on the accrual basis, that same check, okay, on December 31st gets recorded December 31st, but you're going to go with, you're still going to reduce cash because you want the check, but instead of taking it to expense, impacting your profit and loss for 2016, you're going to go to an asset, a prepayment. You prepaid your rent on December 31st. That rent was not due January 1. Does that make sense?
Yes, thank you.
Okay, any other
Can I
questions?
ask another question?
Sure.
Is it okay to not do prepayments and accruals for, say, anything under £500, for instance?
Is it material? Does your business make $5,000 a year, or does it make $500,000? Remember the concept of materiality? If it's not material, then I wouldn't worry about it.
Okay, thank you.
Mm-hmm. Yeah, I mean, no, I have to confess, I'm not the typical accountant. I've met many of my peers who will spend $1 to account for 10 cents. I don't believe in that. And I think a lot of things, you need to look at the overall impact, and does anybody really care? It's the question I have. Does anybody really care if you spend an extra $50 today or you spent it on January 1? And if it doesn't have that much impact, then many accountants wouldn't agree with me, but I come from a primarily, as an accountant and CPA, I come primarily from an industry background, CFO. And we had enough to worry about with the big things to worry about the little things. So you have to decide, okay, is it big enough to worry about? Okay?
Yeah, whatever's practical. Yeah.
Exactly. That's my advice. Any other questions? Okay, so another way to look at the statement of cash flows is to show it reflects the changes on the balance sheet between December 31st and last January 1st last year. Okay? And so it says to you, okay, our accounts receivable went down by so much, so that generated so much cash. Because we collected more receivables. Our payables went down by so much, so that impacted cash. And so you're looking at the way you actually put together a statement of cash flows is you take the ending balance sheet, the beginning balance sheet, you come up with a difference, and you do your statement of cash flow. Now, the one thing that you're going to find that a lot of people don't do, because the statement of cash flows is not as well known as the profit and loss in the balance sheet, as we determined earlier, is the format. You see all kinds of crazy formats out there. But if you want to do it right, and if you're looking at a statement from somewhere else and you want to know if a proper accounting person did this, you will see that they take these cash flows and identify and allocate them to three categories: operating activities, investing activities, and financing activities. If you see that, you can infer that there's a level of sophistication on the part of that accountant that prepared it. Okay? So let's look at an actual statement of cash flows. All right, so here's your operating activities, your investing activities, your financing activities. Okay? Now, I told you that you may or may not see these, and they will indicate the level of sophistication by the preparer. But the one thing that you really want to look for, because I mean, there's so many of these different versions that I have seen, and some of them really don't tell the story because what they're trying to do doesn't accomplish the real purpose, which is see where your money went. The one thing you want to see is this, the very bottom, and they should all have this down here. What was the increase or decrease in your cash at the beginning of the year, or whatever period it is, a month, and at the end? So in this case, you started out the year with 25, you ended up the year with 53, therefore you increase your cash and cash equivalents to 28,000. When we speak of cash equivalents, we're talking about overnight securities or readily marketable securities, things like that. For intents and purposes for our discussion, let's just call it cash. So you see that we increased the cash by by 28,000. Now, we go up here, and there's the 28,000, and it was 23 came from operating activities. We reduced it by 10 from investing activities, and we got 15 from financing activities. Okay? So, apologies for that. Okay, so here's what goes in operating activities. Your profit after tax. You have to add back depreciation, and we'll talk a little bit about depreciation if we have time later, which is a non-cash expense. Okay? You don't put out money. You deducted 1,000. You really have 13,000 in cash on your financial statement, but you took $1,000 deduction, deduction for depreciation, so you really have to add it back in. So we're back to the 13. Now, then your accounts receivable in this particular case decreased. That means you collected some money that was sitting there at the last balance sheet. So you added 4,000. In this case, we didn't do anything to inventories. And then accounts payable increased. Now, that's kind of a tough concept. Why, if my accounts payable increase, do I add 6,000 to cash? Okay, look at it in two steps. You had to buy something. Instead of writing a check, okay, you borrowed 6,000 from the vendor. You put that 6,000 in your bank account, okay, and then it wasn't in your bank account. You put goods in your business, of course, were services that you bought, but you didn't put any cash out of your bank account. So by virtue of increasing accounts payable, you're actually, you got a loan from your vendor. It's a loan. Look at it as a loan. So you got cash from vendors to the tune of 6,000. Any questions on that one? Because that's not that clear. Okay. Then you go into investing activities. Additions, in this case it was an addition because it's in brackets. Deletions to property, plant, and equipment. So we added 10,000 to our plant and equipment. We bought something. Okay? Some drilling equipment. Okay. Then we get down to the financing activities. This is your debt. Net additions to a repayment of long-term debt. It's a positive number, so it's an addition. So we added $20,000 to our long-term debt. So in other words, we borrowed $20,000. Then we got additions to or reductions of capital contributions. So what we did is we drew out 5,000. The owners, stockholders, what have you, drew out 5,000 contributions. The net of that is 15. You add these three together, you got 28. You started out here, you ended up here, you added 28. Thing balances. Any questions on the statement of cash flows before we move on? Okay, a question that's often asked is break even. What is my break even? And it's a very simple little formula, provided that you have, again, and remember how I said how critical it was that you determined your fixed expenses separately from your variable expenses. You know, how much must you sell to cover fixed expenses? And the formula is when sales less direct expenses equal your fixed expenses, you're breaking even. Sold 100, my direct expenses were 100, my overhead is 100, I'm breaking even. Excuse me, no. You lost 100 there. Sales is 100, my direct expenses are 40, and my fixed expenses are 60. So, okay, so the formula is fixed expenses divided by gross profit percent equals break even. So if you take fixed expenses of 30, your gross profit percent is 20%. You take that 30 divided by the 0.20, the 20%, and you come up with 150. And the proof is that if you sold 150, your gross profit percent is 20%, that's 30, and your fixed expense is 30. So now you broke even. Make sense? Any questions? Okay. Depreciation, really quickly because we're running out of time. Remember, non-cash asset, non-cash expense. Depreciation applies to tangible assets, plant and equipment, desks. It's the same exact thing as amortization. Not everybody understands amortization, but all it is that it's depreciation of an intangible asset. Okay? Let's say you have a copy. Let's look at the drug companies. You hear a lot about them losing their ability to market some particular pharmaceutical for X number of years, and nobody can do the same thing. That's a patent. That's or a copyright if you have a book. That's an intangible asset. Okay, and what we do with depreciation and amortization is we allocate the initial cost, whatever it took us to acquire that asset, that patent, that copyright, that piece of equipment over its life. Now, accounting is not an exact science in a lot of ways, okay? Who's to know how many years a desk is going to last you, an oil rig? How long is it going to last you? On a patent, it's a little bit different because in our country anyway, we have exact number of years in a copyright that it's good for. But so what happens is you take the initial cost and you say, okay, my life is 5 years. There are different methods of depreciating. I'll just talk about what's called the straight line method very quickly because we're running out of time. And that method is you take the number of years, the life, and you allocate a percentage every year, the same percentage, of that to expense. So your depreciation, if you have a $10,000 expenditure that you capitalize, you turn it into asset as an expense. You take the $10,000 expenditure. Your life is 5 years. Under straight line, you're going to take $2,000 per year. 2,000 times 5 is 10, and then it's gone. Now, there are variations of that. You can there are other methods. Accelerate depreciation, where the concept is you take more depreciation up front, less in the back end. And it's like a car. The first year you take the car out of the showroom, it's going to depreciate a lot more than the second or third year. So that's also a valid method. We'll get into that in another webinar. The residual value is, okay, that car, at the end, say you took a 5-year life on that car, at the end of 5 years, your books are going to show that the depreciation that you've taken is equal to the amount that you paid. So it shows no value in that asset. But there is a value. You can sell that car for something, even for scrap metal. So that's called the residual value, and that can be taken into consideration. And again, that's a topic for another webinar. So what I do want to say is every year you take an expense of that depreciation. That goes in your profit and loss. Then you add that to something called accumulated depreciation. That goes in your balance sheet. So when you look at the property and equipment that you have, let's say it's the third year of the $10,000 asset, you depreciated $2,000 a year. So the profit and loss is going to show $2,000 for the first, second, and third year. At the end of the third year, you look at the balance sheet, it's going to show accumulated depreciation of 3 times 2,000, 3 years equals 6,000. And that gets you to the net book value, and the net book value is what you booked it at, 10,000, less the accumulated depreciation of 6, your net book value is 4. Any questions on that? Okay. And lastly, very quickly, I want to talk about financial analysis. These are terms that you'll hear, particularly when you're talking to your banker, investor, and you want to at least understand what they're talking about. And you also want to understand what they're going to be looking at when they look at your financial statements to give you money. So one term that's thrown out there a lot is EBITDA. I won't even ask if anybody knows what it is because we're running out of time, but it's very, very simple. Earnings before interest, taxes, depreciation, and amortization. That's all EBITDA is. And they use that a lot more than net income because it is cleaner. It doesn't involve the interest amount. If your competitor has got interest because he's got a big loan and you don't, your financials going to compare differently to his. But if you look at the EBITDA, it gets rid of all that extreme stuff. Okay, liquidity ratios. They want to see how liquid you are, how well you can, you're going to have money to pay the bills. The first ratio we're going to look at is the current ratio. That is current assets divided by current liabilities. Remember, current, what's got to be paid within a year, or what's going to come in within a year. So we take what's going to come in the next year, what's going to go out in the next year. And if that's less than 1, you got a problem. Okay? Acid test or quick. That is a further refinement of the current ratio. Instead of just taking all current assets, which is receivables, inventory, etc., we just take cash, cash equivalents, and accounts receivable. So, okay. So, we divide that again over current liabilities. So, this took out the inventories because the inventory are not as liquid. Accounts receivable and cash. Oops, sorry about that. Okay. Then you got what's called the cash ratio. That's a further refinement. We went from current to acid test or quick ratio to the cash ratio. That's strictly cash. Now we took out the accounts receivable and again divided over current liabilities. That's kind of like really getting right down to the nitty gritty. How much cash you got and what are your current liabilities? Okay, and then we got this is not really a ratio because you're not dividing anything. It's current assets minus current liabilities. That's your working capital. So again, what you got from the bank, which is in receivables and so on and so forth, what's coming in over next year, minus what's going to go out. All right, then you got profitability ratios. And you got profit margin. We know what that is. We take our direct cost, take it out of our sales, and that profit margin is the percentage. And that is compared to people in the industry, like people are going to lend you money and say, okay, well, you know, this guy's got a profit margin of 15%. This other guy, the industry's 30. What's he doing wrong? Is he going down the tubes? Then you got, no, I'm sorry, I misspoke. That is gross margin. That is your gross profit percent. What you make, you know, you take the direct costs from your sales. I apologize. Your profit margin is your very bottom line. What are you bringing to the bottom line? 5%, 10%. Okay, then you got return on equity. How much net income you generated over how much equity you have. In other words, your return on investment. How much income were you able to generate with your investment? And finally, return on assets. How much income you're bringing in based on the invested in assets. And it's just average total assets because normally assets aren't the same all year round. But if you didn't add any assets, it would just be net income over total assets. Okay, that's it. Any questions?
I think we might wait just a minute because there may be some people on keyboards typing. In the meantime, I'd just like to say thanks a lot because that was excellent. A little wobbly from my side at the start, and I apologise for that for anybody who may or may not have been able to speak when they wanted. But this was the first time, and either say aye, or if you'd just like to pop it in the questions box. If people would like this kind of format a little more, because I think it worked really well, please let me know, because we'd definitely like to kind of increase the interactivity, and I think it worked really well. But in terms of questions, it seems like we're low. I'll give it. Candice asked, "Can we send the slides?" Candice, if Ed has this, in fact, I think I have the slides, but also I shall be uploading the entire webinar. So for anybody who wants a link to the webinar, just please send an email to info@webinarsteam.com. That's info@webinarsteam.com. Solomon has a question. I think he's going to be typing it out, although you are unmuted, Solomon, so if you'd like to speak, please do.
Oh, all right. Can you hear me?
Yes, you well.
Yes.
Yeah, the reason why we need to produce the statement of cash flows, it says
Yeah, just breaking up a little bit now, Solomon.
Okay, so my question in brief is, do we still need to produce the statement of cash flows when we are following the cash basis?
No, because well, okay, yes and no. Knowing that you know where your cash went into operations, but you're not going to know where your cash went or came from as far as other activities other than operations. You know, remember we had the financing activities and investment activities. So it's not going to tell you if your cash came from the bank. Okay, in addition to your operating capital, if you pay down your loan, it's not going to tell you if you buy equipment, that sort of thing. So
Yeah.
go back to that slide. Maybe I can yeah, see right there on that slide, you can see where you got, you won't get this information, and you won't get this information.
Yeah.
This will be identical to your cash flow statement. Although remember, even your cash flow statement is going to have depreciation. That's a non-cash expense. So just for that.
All right. Okay.
Candice, I'm just going to mute you because there's a few noises coming over them.
Sorry, could you repeat the email address?
Yeah.
Info at?
Of course, yeah. It's info@webinarsteam.com.
Fab, thank you.
I mean, if anybody, I have a bit of a Northern English voice, so if anybody can't understand, it's sorry, there we go. WEBINARSTEAM. That's Webinars Team. So it's info@webinarsteam.com. Stephen just said thank you. That was great. So thanks a lot, Stephen. We've had a couple of great bits of feedback, so that's great, and it's really interesting to see people's opinions on doing this type of format again. So thanks a lot. I think that we shall leave it there, unless there's another question coming in, but it doesn't seem to be the case. So thank you so much, Ed. That was fantastic.
Thank you. Love being here. Look forward to doing it again.
Great.
Thanks very much.
Thanks a lot.
Bye-bye.
Right. Bye-bye, guys.
Bye.